drink your milkshake. I drink it.
I had to add that at the end. How's it going? Hold on a second. Oh, Scotty's up another. Okay, Masters is out. I was trying to get done like after the Masters ended. I mean, Scheffler's pretty much got it. He's up 4 strokes at this point, so it is what it is. Wan Destin. You know what? Maybe that'll be my new channel name. I like it. Wan Destin. Is that like like the band Wham, right? Thanks for the heads up. I tried to do the announcement like an hour early. I guess that if that it must matter, right? So I shouldn't be doing the live creations like 10 minutes before I go. So I'll try and put them up like an hour or two before going forward. All right. I was debating whether to do this as a video. It's just easier to do live, honestly, for me. I don't have to do unless something goes wrong. Like my last live stream, I had to re-upload it because something went wrong. So I had to put it as a video. So anyways, we will start with, because there's always commenters who are like, man, why you always, when I do videos making fun of other YouTubers, like, why, man, are you tearing people down? Why don't you do something else productive? It's like, I got you, boo. I do 50-50. We'll make fun of people that are embarrassing to investing, and then we'll do some educational stuff. I'll try to. But here's so we'll start with this clip. So it's funny because like you can actually hear Benjamin Graham. There are videos of, they're old. There are videos of things he's talked about. There's no videos of him talking about valuation of stocks. It's other like current event topics. I guess it was more what he talked about. So I thought this little snippet was funny or interesting. So we'll go to
the so-called Wall Street professional. Our Wall Street professionals,
that's not Benjamin Graham,
usually more accurate in their near or long-term market trends, forecasts of stock market trends. If not, why not?
I said you say that they are more often wrong than right on their forecasts?
What I mean is, are they more accurate in the shorter term than the long-term forecasts?
Well, we've been following that interesting question for a generation or more, and I must say frankly that our studies indicate that you have your choice between tossing coins and taking the consensus of expert opinion, and the results are just about the same in each case. Your question as to why they are not more dependable is a very good one and an interesting one. And my own explanation for that is this, that everybody in Wall Street is so smart that their brilliance offsets each other. And that whatever they...
How funny, though, because like this came from 1955, right? Like 80 years ago. And you're like, that comment could have been said yesterday by a super investor. That exact same comment. Like Bill Ackman could have said that comment. The same thing today. That even back then they were talking about analyst projections of stocks back then, which is so interesting. And then it's like the same answers. Like sometimes there's a coin flip with these analyst projections on stuff. So I thought this is an interesting part. Get us started. All right, we'll go to my window. Okay, so here's how I'm doing. I'm like, there's so much value investing channels out there that devote all their time to value investing. Like I'm just covering the basics of what value investing is. Benjamin Graham, like that value investing, and then like some of the things that he wrote from like I have some articles I can show, and then I just want to go right to like some super investors present day, and then how value investing is presented to you on YouTube, which is probably the most important part of this. I'm not teaching you how to value. Now this might be interesting for you because like, I'm not a value investor. So a lot of people that talk about value investing are value investors, right? So they believe in this. So I question how critical they are. They've defined their existence investing as value investor, right? And sometimes I look at it, I'm like, I think they do it because they latch on to Benjamin, or they read The Intelligent Investor, and then they find Warren Buffett. That's like their first investing experience, and then they latch onto it. Now they say they're a value investor. And maybe they don't even fully understand what they're actually getting into because they probably didn't go that far in their due diligence reading what value investing was, right? What are they saying that they're doing? So there's a video. I have some videos underneath this in the description. So Josh Brown, who you know from the Compound, he wrote. There's a video I'd linked plus this article he wrote, and his opinion is kind of funny. Value investing is immortal. That doesn't mean it's good or bad. It's just it's going to be with us forever. So he always like he kind of rails against value investing. So let's see. He talks about how it used to be like it's like Game of Thrones. It's dead, and then it comes back. Where was the one part I wanted to read? But yeah. So people ask him what value investing is. He said it's basically you try and buy $1 for 75 cents. And we'll get into more about what historically it looks like. So you're trying to buy something for a cheaper price than it's actually worth, right? Well, who isn't, right? That's the whole point of investing to some degree. So his analysis also talked about this weird dichotomy between value and growth stocks that developed as far as prepackaged products in the US, right? And I can show you like one example I can have is Schwab. Schwab they have a large index fund that's their version of the S&P 500, but it's the Dow 750 Schwab. They then take it and they split it between growth and value, right? And they're not the only ones. I looked at some other fund. Morningstar does this. I think CRISPR, which I will show later, does this also. So as far as an investing product, like this is what's happened to you, right? So value investing now has become like an investable product where they take like the 500, 750 biggest companies in America and they create some metrics to split them in half or split them apart. And then you can buy the value or the growth side. I question how much value that does have. Looking at some of the past historical data of those funds, that doesn't seem like it brings much value to you rather than just doing market cap weighted funds. So these are prepackaged products. So it's kind of one way it's been given to you. So he goes into this like to comparing Hershey, which is a value compared to Netflix. Obviously, you know, Netflix has vastly outperformed Hershey's. So he talks about like you could have said that Netflix at certain times was a value play, right? Some people could have said at certain points it had like when it dropped after was it a year and a half ago, they had the drop in subscribers, which caused the stock to drop. So was it a value play at that point, or was it still a growth stock? It's like this whole like argument about body types for people. Like, do you really have one body type, or is it just whatever you look like at the time is your body type, which is all fake anyways for health? But so his point here, value investing is immortal, cannot die. Perhaps the way it's been traditionally practiced is dead, which we can get into. The metrics that the value discipline has been based on are not and have not been relevant for a long time. So this is his opinion. There have been a revival of interest in these metrics. The investment world may wake up one day and decide it does not care about them again, but there's no guarantees. Every indicator eventually bites the dust. The famed technician. Okay, this is some person said. So that's his opinion. You might see I post jokes and other people I know post jokes about like value investors online, which I find hilarious. So this is like what value investing has become in the current internet. The jokes, anyways, you got to appreciate it. Only buy stocks under 15 PE. So value stocks now have become cheap stocks, right? Which is to me two separate ideas. Writes lots of detail describing industries back, does 20 years of research and then traded on 9x PE. Why should I buy it on 20x? Implying that they base their information on historical data, which they're not looking forward, which is something I've kind of complained about with value investors. This one's the funniest though. Owns every part of the value chain except the one that makes money. And that Mr. Market knows that. Where's your edge? Which Mr. Market is from some of the core tenants of the Intelligent Investor. So there's your jokes. Okay. So what are we talking about? Now we're talking about like what was value investing as far as historically with the Intelligent Investor. It's this whole idea of buying a stock under its intrinsic value. Okay. So intrinsic value is this line. You have some way using math is what a lot of them do, some methodology to value the actual intrinsic cash flows that are coming in the future, combined with the the assets and liabilities of the company present. And then you find out after you put a margin of safety in there, which is like your safety for the unknown. Then you find out when you should buy it. Okay, so it sounds simple enough. So without reading an 800-page book, and I'm not going to review The Intelligent Investor, I hate to break it to you. So I linked this below. Value investing emphasizes 4 ideas. Okay, intrinsic value. Any corporate security has intrinsic value or value which is justified by facts. Okay, assets, earnings, dividend, prospects of the future. So cash flows projected forward, discounted to the present. Margin of safety. The lower the price of security, the relative. The lower the price of security relative to the intrinsic value, the higher the margin of safety. That's where you see these channels do this. They do the percentages. So they'll create these percentages of return, which is like how they derive a margin of safety, which gives them stock prices. So as the stock goes lower and lower, they'll be like, oh, I have a better margin of safety on this stock because my rate of return increases, which is, reduces my risk of underperformance, supposedly. Mr. Market, you'll hear this term. You should view the market prices as if in business with a manic partner, repeatedly your partner offers to either sell or buy your shares. So it's just talking about the unknown of the market, right? That none of us can know. So there's that part. Diversification for risk management purposes, you should carry at least 40 different stocks. That's kind of, it was an interesting part. Okay. Okay, this now. So now we're going to look at 2 things I pulled up from the past, right? Let's not all live in the present. So here was a research paper. It was like a research paper slash interview. I believe this was done right before he passed away or something. So it's hard to pull stuff this old up without paying for services. I have to dig sometimes to find stuff like this. So I will do it for you. So here they talk about like, what did Benjamin Graham actually do? I don't think people talk like, what did he actually do as an investor? So here was an example they wrote in this. This is from 1977. So they talk about the cigar butt idea. This was what he was doing. He was buying companies, right, where he could look at what was on the balance sheet, which is based on book value, and he was figuring out the fair market value of the assets of the business, and he was looking for companies, like this is an example from this article, where the market value of the assets and the cash and minus liabilities of the company created a higher valuation for the shares than the actual value of the market shares on the open market, to the public. So here's an example. This company was trading at $68.88. He calculated the value of the stocks. The shares were actually $76 based on, you can see here, some of his calculations. And they just go through, and then this was like this was early Benjamin Graham, because the date of this is 1916, talking about that. Okay, so you might call this cigar butt investing. It could go by many names. This is not really what you perceive as value investing on YouTube. So this is not what a value investor presents to you on YouTube that I've seen. So could you do this? We'll get into like, is this applicable anymore? So this is like what he was doing, his claim to fame. And then I'll go to the interview part. There were 2 questions I thought were kind of interesting. Give me a second. I highlighted them. Okay. So this was one question. Is it bad not to have made more contributions from practicing analysts to provide some balance to the brilliant work of academic community? And then when we talk about buying stocks as I do, I'm talking about very well practically in terms of dollar and cents, profits and losses, mainly profits. I would say that if a stock with a $50 working capital sells for 32, that would be an interesting stock. If you buy 30 companies of that sort, you're bound to make money. Okay. So you kind of get a sense of what he's doing. He is doing this groundwork at a time when there's no internet. There's no supercomputers that can analyze financial statements. He knows, because he's a professional investor, he was able to go into the financial statements and the annual reports and find companies like this, right? And invest in them. And it's not that different of an idea of what Peter Lynch was saying. Peter Lynch, though, took this kind of perspective just in a different way with growth companies. Whereas Benjamin Graham was like, well, if I can find my edges, I can read and interpret the statements, their financial statements, find these companies undervalued, meaning that like the cash on hand and the value of the company intrinsically is, under the stock price. And I can buy a bunch of those companies and I'll do well. What advice? Okay, this is funny. No, this was, I think, near the end of his life, this interview. What advice would you have to a young man or woman coming along now who wants to be a security analyst? Okay. So they're like, what would you tell if someone wanted to be you? Which Warren Buffett, who, every super investor gets these questions. I would tell them to study the past record of a stock market, study their own capabilities, and find out whether they identify an approach to investing they feel would be satisfactory to their own case. He's not even telling them they should do what he did. Okay, bear that in mind. Okay, and if they have done that, pursue without reference to what other people do or say. Stick to their own methods. Okay, and that's what we did with our business. We never followed the crowd. Peter Lynch would agree with that. And I think it's favorable for young analysts if he or she reads Intelligent Investor, not Security Analysis. I don't want to read either one, honestly, and selects from it some approach that they think would be profitable. And then I would say to one of them to stick to it. Then he talks about some nephew, he said. So interesting. He's not even pushing you to do what he did in this interview. He's saying you could take some lessons from his book and then apply it to your own personal experience and capabilities. Very kind of Peter Lynch-like, to some degree, what he's saying. So stay in your core competencies, develop your edge. All right. There we go. Now this is the fun part. So, this was another interview. This thing is, I had to like tweak this so much in Canva to get it to work because it came like fuzzy and it was like crooked. It was such a pain to get it right. So that's the cover. And then we'll go to the next page. So here's the juicy part. Okay, this question. I think you can you see it? Okay. In selecting the common stock portfolio, do you advise careful study of the and selectivity among individual issue? So we're talking about like investing actually here. In general, no. And then here he goes. I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities. Okay, so I don't know how many people are aware of this. Some people are that I've talked to. Near the end of his life, he started to tell people his original investing process that he outlined, the whole value investing cigarette butt idea, was no longer applicable by the 70s. And he was not practicing it at that point. He said it no longer provided the returns that it used to and provided an edge. Okay. This was a rewarding activity, say 40 years ago when our textbook Graham and Daw was first published. But the situation has changed a great deal since then. In the old days, well-trained security analysts could do a good professional job of selecting undervalued issues after detailed study. So his edge was he could find this information because it wasn't readily available to the public and you had to know where to find it. You probably have to call the companies to send you this information. It wasn't just, there was no internet. Okay. But in light of an enormous amount of research now being carried on, so this is like 70s we're talking, I doubt whether in most cases such extensive efforts will generate sufficiently superior selections to justify their cost. To that extent, I'm on the side of the efficient market school of thought and now generally accepted by the profession. So he changed over his lifetime. Now, what does he sound like? He sounds like an indexer, right? Except those tools didn't exist yet. Okay, so bear that in mind. He didn't have the option of selecting investing in cigarette butts compared to low cost index funds. He didn't have that choice. But you almost could see his brain was. From what I've read of in interviews, he was thinking of this before these products existed. Near the further end of his life. Okay, what general approach to portfolio formation do you advocate? Essentially, a highly simplified one that applies a single criteria or perhaps two criteria to the price to assure that full value is present and relies on it for the results of performance of portfolio as a whole on a group of results rather than expectations individual. So he's saying a simplified metric for a group result, not individual stocks. So you can see his thinking changed over his life. He he accepted that his initial investing methodology didn't work anymore by the 70s, before his death. So interesting. Okay, I need to pull out, I couldn't highlight this one, so I had to write my pages. Okay, so this is, you can find this, Something of Value from Howard Marks. Okay, so he talks about value investing. So, and it actually applies it to modern day. Value investing is key discipline of world investing, consists of qualifying something is worth intrinsically based on primary fundamentals, cash flow generating capabilities, and buying its price represents meaningful discount from that value. So, okay, we're defining it. Let me zoom in a bit. So we make sure you separate. We're talking about value investing. We're not criticizing valuing a stock, right? You have to value a stock to buy it. That's separate from being a value, quote unquote, investor, right? We all have to value a stock when you buy it, but we're not all value investors historically based on, what they implied in the intelligent investor. Value investing recognizes that securities they buy are not just a piece of paper, rather ownership stake. Okay. So essential underlying principles of value investing, focus on the true worth as opposed to the price. So they're talking about, again, we're looking at what's on the balance sheet, discounting the future cash flows back to present values, use of fundamentals to calculate intrinsic value. So we're based on present book, past performance. Nobody's really talking about like the future of a company, or management and their decision making. None of that is involved in this. All right, let me go cigarette butt. Hold on. So you talk about, it was applied, Benjamin Graham developed a low valuation style deemed cigarette butt investing that was followed by his protege Warren Buffett, emphasized the search for pedestrian companies whose shares were selling at discounts from liquidation value based on the assets on their balance sheet. So we are buying crap companies that just the share price got below what the actual value on the books is, and maybe no one did the work, or they bought some of these assets so long ago that the actual present value is different from what's on the actual balance sheet of the company. All right. I'm going to skip forward. This is taking a while. I don't want to go crazy. Okay. Fast forward to today, everything has changed. The investment industry is wildly competitive. This is Howard Marks. Tens of thousands of funds, trillions of dollars. Investing management is one of the most desirable careers. Okay, he talks about that. Let me skip forward. Information is incredibly ubiquitous. Again, here's the point. Is like the game has changed since this style of investing was actually effective. Seemingly endless amounts of data, not to mention books, articles, blogs about the investing methodologies of specific stocks, and then you can access on your phone. Information is broadly available and easily to access for you. So the whole point, you could argue the competitive advantage of value investing was that the information wasn't readily available and it took professionals that knew where to find it. And then their edge was their analysis of that hard to gather information that made value investing originally something that worked. We're talking like 100 years ago, right? This is long, long time ago. Before his death, he already admitted this was not a usable strategy anymore by the 70s. Okay. Think about how much more data we have available now from the 70s to present day. Okay. Start far. In the past, bargains could be right here. In the past, bargains could be available for picking based on readily available observable data and basic analysis. Today, it seems foolish to think that such things could be found with any level of frequency. If something about a company can be easily read in an annual report or discovered on a computer, it stands to reason that in most cases, this should be appreciated by the marketplace. So he's saying like efficient market, thus incorporated in the price of the security. Efficient market hypothesis. That's now the second value investor talking about efficient markets. Okay. So this type of investing kind of seems dated based on two people now. And then he goes into this part, which is something I would say, if something carries a low valuation, there's a good reason now that information is more readily available in the market. So the disconnects between intrinsic value and the stock price are getting closer and closer. They're not getting further apart. And then he harps about low PE doesn't mean cheap, or cheap doesn't mean low valuation. It depends. And then there's other things come into consideration, like, is this company turning around or not? Is this a value? Is this deep value, or is the company just cheap because it's crap? And then this probably like successful investing has to be more about superior judgments concerning qualitative, non-computable factors. This is what modern, and we'll see some people on YouTube. This is the hard part. I think a lot of investors struggle with non-computable factors. I love that term, right? We're not getting too scientific here. The unknown, the value, and be able to assess the unknown of the future, and put a risk analysis on it, and move forward. There's a lot of, I see like a lot of these so-called value investors on YouTube, they don't have a recognition of the non-computable factors of investing, right? Because you can't quantify some of it. How could you quantify Disney's turnaround of the company? Nothing of their like last fall, nothing from their current books and their past performance could indicate if they could do it. They didn't even have Disney Plus 5 years ago, if you were going to do some sort of analysis of past performance. So there's the unknown of if they could have done it, right? And you have to assess that risk and define it and decide if it's worth you actually buying the stock. So we'll move on. Let me go down to 11. This is a good read. This is a good read for anybody, actually. I'd recommend it. You can find it online. So this is very interesting what he wrote here. Okay. Andrew insists that when you're talking today about great growth companies, the approach to buy in cheap, set a target price, sell as it rises, and exit when fully reached its target is dead wrong. A dispassionate look at history makes it clear that taking profits, rapidly growing companies, durable competitive advantage is a mistake. Okay, that's not the part. No, we will skip down. I don't want to read too much to you. So this is like his conclusions. The search for value in a low price securities are worth more than you should just one of many important tools in your toolbox. That's where I'm going to come into this more. I'm like, this is value investing as an idea, I think could work. But it's a tool. I don't think it's your entire portfolio. The idea of you could, and I there are present examples of people that have done value investing as defined by Benjamin Graham. I find it hard to believe you can have an entire portfolio of this strategy and it's going to outperform the market. But I think this is a tool to consider, that these opportunities can exist, and I don't believe they're readily available all the time, but it's just something you should put in your toolbox as an investment, just like social arb trading or growth investing, other investing methodologies you could follow. Even investing on a discounted cash flow model, which I've done that too. All these things could come into play, but I don't think any of them are something you could wrap your entire portfolio around with and actually outperform the market to some degree. Because I really don't think these opportunities are always out there, which any strategy you're going to find, it's going to be hard to identify enough to fill an entire portfolio with that specific of a strategy. So what else do you say? It doesn't make sense for value investors to bar investments simply because A, they involve high-tech companies that are widely considered to have unusually bright futures. A lot of value investors don't really have a lot of tech because it's highly valued on multiples basis. So remember, what YouTube values become is like buying cheap stocks, right? It's not what we just talked about, like his historical writings. They're just buying things because they're cheap. Well, then you're going to miss out on a lot of amazing, high-performing tech companies of the last 20 years. And in very minimal periods of time, you might perform better if it runs high, it's high beta, it can go down fast. But historically, long-term, it's done quite well. And you would miss that performance if you didn't have that in your portfolio. And then he says here, futures are distant and hard to quantify. And so that, again, value investors have trouble looking at future non-computable factors when they look at a stock. There are potential causes this potential cause their securities to be assigned valuations that are high relative to historic values. Okay. So his final conclusions: value investing doesn't have to be about low valuation metrics. So Howard Marks is telling you this. Value investing, it does not have to be what it became, buying cheap stocks. That's not what it's about to him. He thinks it can be found in different forms. So that's where the people say that everyone's a value investor, which I can't, don't say that to me. It's such a dumb term. It doesn't make sense. The fact that a company grows rapidly, relies on intangibles such as technology for success, has a high PE ratio, shouldn't mean it can't be investable based on intrinsic value, which there's no specific, it's your opinion what the intrinsic value is. And that's very hard to define. And that's a key to the value investing in the general. Like, there is no intrinsic value that everyone would agree on. And you're going to spend a lot of time trying to debate and figure out what that intrinsic value is so that you can discount it and maybe make some money. What else? Since quantitative information regarding present value is so readily available, success is highly competitive in this field of investing is more likely to be the result of superior judgment. Okay, again, we're bringing people back into this. And a lot of value investors don't want to do this, but companies are run by people. Stocks are bought and sold by people. You can't bring investing down to just a numbers game. To me, there's people, when people involves mistakes and emotion, right? And you can't just not count those because they're non-computable to you, which is something that has developed the modern day value investor, it seems. Let's see. The fact that the company is expected to grow rapidly doesn't mean it's unpredictable. They don't like unpredictable companies. That's the other thing with value investors, because they can't quantify the future. So they try and let's be fair, they like ignore the future of a company. And they said, no, I do the future of the company. I take their future cash flows and then I discount them to present day. I'm like, well, that's not actually talking about where do you think the company's going? Like, let's not just talk about the money. Like, where do you see the future of them? Like, do they have a bright future? How is regulation going to be in their way? Any sort of future analysis. And it just argues, like, is a value stock a good stock once they do a turnaround, right? Is that what defines a value stock? When they turn the company around and instead of just being this slow meandering conglomerate that doesn't improve margins, anemic growth in their cash flows, all of a sudden they decide to pivot towards profitability and they do something more valuable for investors. General Electric, right? But is it still a value stock, or now is it a growth stock? Okay, so do you have to sell GE now that it's appearing to grow again and they've done something that actually could be exciting? So this whole specific say I'm a value investor is very odd to me. But I'm a dividend. Then again, I would tell you I'm a dividend guy, and you could say dividends are stupid. So we can have that disagreement. That's fine. But we all kind of identify ourselves as something. Lots of you are growth investors on YouTube because you like tech, because you're on the internet. So there's that. So, like, just to show you, like, here's a index methodology guide. So this is how, like, value is like we talked about with Moat. So Moat is a packaged product because Warren Buffett talked about it at shareholder meeting. If you remember from my video, Morningstar ran with it as a marketing tool to create funds that you put money in and they get expense ratio. Okay. So, like, here's how value is value packaged to you, the investor. So they have value growth indexes. And here's some of the methodologies. So value factors, here you go. Price to book. Okay. So again, we're dealing with intrinsic value of the book, right? Are the assets on the books worth more than the stock price? Something like that. So here they're plowing into that. Historical earnings. Again, we're backwards looking with a lot of this. Sales to price. Okay. Now growth, here's how they define growth. Long-term growth earnings per share. It's just tough because projection, not every company does projections. 3-year historical growth and earnings per share. But we are trying to project forward growth. So this is like how they package it to you. Schwab's was not as easy to show you. There's different companies that do this, but in essence, they'll take like a big index and then they split it in half, and then, or it's usually not half, it's mostly value and then some growth. But this is what they package it. This doesn't sound like Benjamin Graham. So this is just how these companies have marketed it to you. So is this value either? Does this matter? We've done lots of videos to show you that market cap weighted funds are the superior way to go with investing. So again, this doesn't really provide much value, I don't think, to you as an investor. So let's play. Okay, Okay, hold on. Anybody? I don't know what you question. I'm just going to ramble. Graham was making ETFs before there were ETFs. He was just buying 30 companies where 20 would do okay and 5 would go bust. Yeah. So some of the interviews I read, he created this edge of being able to analyze their books, and he just went right into that, and he would buy a bunch of companies with those criteria, and he knew some would do well, which is not that different with Peter Lynch. Peter Lynch did a similar thing, except he was more on the growth. He was trying to buy companies that would explode in growth. So Peter Lynch would buy all these companies like La Quinta, maybe the slight edge. He understood it before the market would because they were small. And then some of them could do 10, 20x and some would go belly up. But so they kind of were on, like, in theory, same idea, just they approached the same principles in different ways because they were from different times. Alpha decay. Okay. They should have bought 6 months forward lows. Revenue growth 8. Oh God. Yeah, we know Paul from Everything Money. 12, 14, 16 PE when he does his valuation modeling. It's paying every company. I swear to God, every company. So more dividends. Can we derail this by looking at Cybertruck deliveries being halted? After I'm done. I mean, I guess we could go live later. My wife goes to work later. I could come back on live later if you wanted, Andrew. You know what, Andrew? Anything you want, I will do. Because you did me a solid. So it's up to you, sir. Who is Link? I don't know. Did you look at Schwab's rankings and valuation portion of the rank? I think you asked me that. It's on my list of stuff to look at. This stuff takes a while. Like, honestly, like, topics like this take like 2 weeks to look at and just compress, just take in the information before I can talk about it. So, it's good. Oh, okay. So while he's typing, let me show a video. Hold on a second. Where'd it go? 1 second. Oh, I don't know where it went. Okay, wait, hold on. You have to open each individual tab. It's like painful to do this. Can't find it. Give me 1 second. Okay, we'll show this first. So, who remembers Roaring Kitty, right? So let's hear him talk about what value investing is him. Because I would argue Roaring Kitty is Benjamin Graham original in modern day times. So I think they call him deep value investing. This is like the modern version, I would say, of actually what Benjamin Graham was doing. So we'll just play part of like what he talks about value investing.
And I jotted down a couple of reasons why. And the first is I'm not in the camp that thinks value's been underperforming. I actually think it's been tremendously successful over the past decade. So I just think it's funny when I see those headlines, is value dead? Is value dead? Is it coming back? And I try to think about why everyone thinks that. And the most obvious reason is just because we all lean on those oversimplified ETFs to measure the style's success. But I mean, that's not a good way to measure a bona fide value approach. It's
you're saying the ETFs are not,
and part of that is because value is so subjective. It's not so simple that you can just boil it down to a couple of metrics or something like that. So because it's so subjective, it's difficult to measure its success. And I think that's part of it. I think what matters, many people think that it matters like getting an accurate valuation, right? But that's ridiculous. Like no one cares. Who cares? No one cares if you can accurately value a stock, which is, I mean, you can't even get an accurate, precise value, right? That's ridiculous. But even if you could, even if you somehow successfully, perfectly measured a stock, the value of a stock, the market doesn't give a shit. No one cares, right? What matters is incorporating those values into a framework that you can leverage over time to profit, to outperform the market. I mean, that's what matters. So unless you have it's the framework that matters. And within that framework, value is but one factor, right? There's other things that matter too. And so for that reason, I find it's beneficial. Don't waste so much time valuing one particular stock. Just get a general idea as to what that valuation is and do it for as many stocks as you can and as consistently as possible. And then you can tap those and incorporate it more easily, in my opinion.
I totally agree. And you notice, so he's a value investor. He does not put a lot of effort into discounted cash flow models. It's more focused on the business itself. So that's why I think, I don't know if he's like the deep value first, but he's kind of created to me, like, this is true modern day value investing, what he's describing. They do call it deep value. I think he called it Roach. There's the Roach investing once, like not a cigarette butt, but a modern version of it. Okay. Let me go to his. You should all go watch his old videos. They're all on public. He doesn't do videos anymore because he's freaking rich as hell. But okay, hold on. Let me pull this one. Come on, where is it? Hold on a second. I don't know why I can't find it. Just give me 1 second. Freaking off the rails. Okay, we'll do it this way. This will work. Okay. So we're gonna. He talks about enterprise. So we'll play both parts. I thought they were both interesting. So this is why he bought GameStop for the most part.
At a market cap of 260 million and an enterprise value of about 100 million, the downside is limited. Following major write-downs and balance sheet repair, their financial situation is pretty solid given the circumstances, with a reasonably fair net asset value of about 400 million. They just closed Q2, which will be another rough one. But following that, I expect earnings to improve significantly based on GameStop's market share.
So you can see what you see what he said, right? Market cap of 260 million. He calculated a fair market or fair net asset value of about 400 million. So he is doing the intrinsic value. He is doing what the original Benjamin Grab model was. He's saying, and I knew this from before because I was following him, saying what was on the books at GameStop was worth more than the stock price reflected. And Wall Street wasn't appreciating because they thought the company was dead. And that's how he found it. Okay, we'll go to the next part. Enterprise. Okay, this part too.
This is the first margin of safety that sticks out to me. Now, if we go back and we take a peek at enterprise value of about 104 million, and then based on my estimates, I do think the company is going to generate EBITDA of over 100 million over the next 12 months. So then you're looking at an EV to EBITDA of less than 1. You don't see that too often, especially with a balance sheet that looks like this. So that's like, whoa. I mean, we get it, right? It's because of all the negative sentiment, but still. And then I'm looking at just the sheer level of revenues, right? 6 billion on revenues at the tail end of the console cycle. I know people are focusing on the year-over-year decline, right? That's important. Is like, is this trend going to continue? But I mean, when you're trading at about 4% of those revenues, that's a tremendous amount of operating leverage. In that, if they can turn things around or just stabilize things, then the upside could be meaningful on that front. And so that's what I mean. It's weird to see a stock trading so cheap with so much operating leverage. With this strong of a balance sheet, it's pretty unusual. This is the opportunity. And we talk about margin of safety and how it historically performed. Right? If you take a peek at simple free cash flow, operating cash flow less capex, and how GameStop performed in the first 3 years of the last cycle, the company generated about $6 per share, using the current share count of about 65 million. They generated $6 per share on average over those first 3 years of the last cycle. Yes, I know historical performance is not necessarily indicative of future performance, right? It's not lost on me. But I'm just saying,
so you can see, like, these are great video. You should watch all of these. Honestly, this is a true modern day value investor of the highest sort. This guy trumps. I remember following him during the whole GameStop and before that. He's an incredible investor, and you should all pay attention to him more than anybody else that calls himself a value investor online. It's a shame he doesn't do any of this stuff because he's rich, because it works so well. He doesn't have to make YouTube videos anymore. He doesn't have to grind. Isn't that the point of all of this? So that's Roy and Kitty. All right, I can't get my videos to pop up, so we're gonna have to do it this way. you have to tell me if you can you hear this? Hopefully, it's a freaking shit show here. Okay. So here's an example briefly of Bill Ackman's best investment ever. Okay. So we're talking about modern day and value investor, super investors kind of right now, which I think Warren Kitty's a super investor.
And they had a $5 billion of stock that was worth 25 million or something by the time we bought a stake in the business. And what interested me was I thought the assets were worth substantially more than the liabilities. The
Can't hear it? Oh, okay.
company had 27 billion of debt and had $100 million value of the equity, down from like 20 billion.
So there we go again.
And one that,
The value of the company
with the stock
was
down 99%.
higher than the stock price reflected.
But the fundamental drivers of the mall business are occupancy. How occupied are the malls? Occupancy was up year on year between 07 and 08, interestingly. Net operating income, which is kind of a measure of cash flow from the malls, that was up year on year. So kind of the underlying fundamentals were doing fine. The only problem they had is they had billions of dollars of debt that they had to repay. They couldn't repay. And if you kind of examine the bankruptcy code, it's precisely designed for a situation like this.
So he identified this once in a lifetime opportunity where the business was a solid business, but a once in generation economic event, the Great Recession, happened, and this company was kind of in a bad place as far as their debt. And his edge was he understood better than the market that the bankruptcy codes would allow shareholders to keep their equity in a case like this, where there were more assets than liabilities. So you can listen to this whole part. So this is a great example of modern day value investing also, to me. So there's now two examples of what I would say is real value investing from the original thesis of where it was created. And now again, you have to ask yourself, do you think you can fill an entire portfolio of stocks like this, of stocks like GameStop, and then a Great Recession mall company that had some brief trouble? I don't think you could fill a portfolio full of companies like this, which is kind of the point of this. So I agree with Howard Marks. I think this is just a tool in your tool belt, this style of investing. I don't think you can have your entire portfolio be companies like this, because I don't think they're always around. A lot of these investing processes that people always harp on, that's kind of what I think at first. I'm like, I don't think you can do this all the time. I don't think you can identify these opportunities constantly to fill an entire portfolio of companies, whatever you identify, growth, value, whatever you want, dividend growth. It's very tough to fill a whole portfolio of all your funds in that style. I think some of your investments are just going to be to fill out this portfolio, and they're not actually good investments, but you're just trying to fill out, your roster, let's say, right? Like a sports team. You don't have 9 good baseball players. Maybe you have 3, but you still got to play the game. All right, so let's bring this over. This will be easier. So this is kind of boring, this part. I didn't find anything really juicy about Mohnish Pabrai. I'm not a value investor, shoot me. I don't really agree with this style of investing. It's not what I grew up with. So I'm just going to play this clip because I couldn't really find much better for Mohnish.
And so intrinsic value, the definition of intrinsic value is relatively simple. Calculating it in most cases is far from elementary. So actually it was John Burr Williams who came up with the concept of intrinsic value and defined it several decades ago, and maybe about 100 years ago. And he said that it was the sum of all the cash you pull out of an enterprise between now and judgment day. And then you would discount it back to present value by some reasonable interest rate. That would intrinsic value of the enterprise or a real estate or anything else. And of course, when we apply that to businesses and stock market equities and so on, it is a far from elementary exercise, because projecting cash flows for a business several years out, even the insiders in the business who maybe have even been running it for 10, 20, 30 years may have difficulty.
What happened?
Tack is that we don't need to know the intrinsic value of everything. And processes go by the wayside because they fall outside of circle of competence. Other thing.
Okay, so you talked about intrinsic value. I linked this video below too. All right. Now this guy. So now we get to pick some bones with some people. that annoy me. Okay. So I'm gonna play a clip. This is his value investing definitions. So let's play this part.
We want good businesses, good earnings, but we also focus, and the first thing a value investor should do is focusing on risks. Value investing doesn't like risk. And then you look, okay, the lower the stock price is, the lower is the risk that it will go with.
Have you seen anything I've talked about to this date talking about risk as far as what he's saying? That value investing is about low risk. Nothing I've said yet, all to this point. So I don't know where he's getting this from. He's creating some new definition of value investing now.
And lower if there is low business risk. If the business is a financial fortress, as I said, for Berkshire, it's good, it's strong, then you know it's also important, okay, if a business can survive a crisis or keep being profitable in a crisis like Berkshire has, and it's not liked by the market to calculate intrinsic value in a second, then Tesla
and we go this part.
Growth, not Tesla.
This part killed me. So this one right here, low price, good businesses equal low risk, high return. Like that, nothing I've told you from Howard Marks, Benjamin Graham, nobody has said this. So all of a sudden, Sven Carlin comes out of left field, and now we have a new definition. This is what I was talking about. Here's historically value investing, super investor value investing. Now we're YouTube value investing. Like, so he's just created this. Like, where the hell is this coming from? Wouldn't you all like a low price, good business? You know, who wouldn't? But that's the tough part of this. So are we buying cigarette butts anymore? Like, what is he talking about? Are we getting into quality investing now? He's muddying the waters here a lot. And I got to say, so I looked at, okay, so what the hell is he buying? Okay, he had a video, 10 worst investments ever, which you can go look at his channel. It's a bunch of penny stock trash micro caps from like international companies, from like third world, like emerging markets. I'm like, where did you find this is value investing? You said low risk, good companies, and he's buying penny stocks in foreign countries. So Sven's all over the place. I'm not a big fan of his. I don't know a ton about him, and people have told me things about him that are even more questionable. But we can look at, okay, here, 10 stocks from my list to buy. Okay, so we can go through some. This was from 2022. Okay, so first one.
Cash flows now,
Disney.
but it has the potential to achieve those very high cash flows. Analysis.
Let's see what
and you can see with.
So he said Disney was a good buy in 2022. Spoiler alert, it didn't do very well. After this 103, it went down to like $80. There was no reason to buy Disney in 2022 to me. So I don't understand where the value play was in this. So D- on that one. Let's go to the next one.
And as Warren Buffett,
Verizon, there you go. Of course, value investors and dividend investors merge at Verizon, AT&T. I swear to God, like that's if you drew the two circles of value and dividend investors, that little in the middle area is telecom companies. So spoiler alert, it's not $50 anymore. So trash. Another D-. Of course, what is a value investor or a dividend investor without 3M? So here, 3M, he's throwing this on you. All right, F-. This stock, dog shit since then. Oh, I should not swear. I'm going to get ad blocked. Next one. Oh, you didn't have one here? Apple. Okay. Did okay with Apple. I would argue Apple, I don't understand what the value stock play would be with Apple. You could argue it's a growth play. Historically, this is not a value investment. So, okay. Whatever. It's funny, his best performing or kind of questionable value and more of a growth investment. Netflix, again, is that really a value stock? I would argue that's always been a growth stock. Their valuation is based on increasing subscriber counts and now increasing revenue. Google, like, this is funny, like the value investors merge over to growth when they actually want to perform, if you've noticed that. And then they have to wiggle into calling this a value play, actually, when I don't know who would argue these are value plays. But magically they have those in there so they can actually perform okay. AT&T, of course he has to have AT&T, another trash investment. So there you go. Okay, this one. This guy kills me. So here's Cameron remember, value investors on YouTube do discounted cash flow models, which it's questionable even if that's value investing, because Roy and Kitty would tell you he doesn't even do them. And Howard Marks didn't really comment on the value of them either. Benjamin Graham did talk about it, valuation, right? And there is valuation metrics that they used, not specifically DCF. But here, this is his thing. He's the DCF man, right? So Cameron, he's like,
just to give them
Boeing,
an obscene amount of cash.
Boeing
And
from
some of that
June
debt
7th,
is
2020.
10-year debt at 5%. So I think
So we're going to value Boeing
is
on
there
a cash flow
caveat, the
basis,
recent
right? Because that's how you should
pandemic,
value
the
Boeing.
shortfall of the software may produced a buying opportunity. So I'll give it.
So here he's got
on
all
the
his fancy
revenue.
metrics:
Earnings growth,
CFO,
yes.
capex,
Strong
debt
free
payment,
cash flow, yes. Balance sheet,
free cash flow.
Balance sheet's iffy,
by
so
share.
I'm gonna look
look at all these hot numbers,
or
dude.
outperform. Right, that's
Just
what you want.
amazing.
I don't want to underperform.
Did you catch that? So by 2029, it should be a $358 stock. We're going in the wrong direction. So things have gone wrong, really wrong. So remember, we do not look at non-computable factors when we value according with people like this. So obviously I wouldn't have known a door blew off a plane, but if you had any sort of competency in aerospace or military companies, Boeing hasn't had a stellar record in some time, and that would have existed in 2020. The concerns about Boeing still, and I believe the 2 planes fell out of the sky before lockdown, so he would have been aware of pretty sure, right? So no mention of that, because you can't put it on a spreadsheet. You can't calculate those risks, the political risks of a company like Boeing. I would have looked at Boeing and been very concerned that they moved their headquarters from Seattle to Chicago, which I believe it would have been in Chicago at the time of this video. That would have been concerning. So again, they don't look at management, right, at all, because they can't compute it, and there's no computable value to management. So here's where this modern take on value investing or rational investing fails, in my opinion. Stuff like this is when it fails miserably, because they don't factor those types of things in their analysis of a company. Where do you think it's going in the future? Like, not just the cash flows in the future. So anyways, you can see his share prices, and then at the end he tells you, oh, here's the rate of returns you're going to get at certain share prices. I find this ridiculous. If we can agree to disagree. If you do this stuff, fine, good luck to you. I don't think you're going to perform well over just buying like the S&P 500 and then buying some individual stocks in your core competencies, or shorting stuff in your core competencies. So I don't think you're going to do well. I think you'd be better off doing core satellite. We can disagree. It's fine. So, you follow these guys, you might buy Boeing because the spreadsheet told you to buy Boeing. I guarantee you I would have told you to avoid Boeing in 2020. I didn't need a door to blow off to know that. All right, so we'll do let me go here. By the way, also, Sven did a video right after ADM. Archer Daniels had accounting issues. And Sven immediately puts a video out, puts a valuation on it. I'm like, how can you value this company? Because here's an unknown, right? But they don't deal in the unknowns, non-computable. You can't put a price on the risk of those accounting issues that were ADM declared. So he just doesn't, right? He just values whatever the present balance sheet is and discounted cash flow based on historical values of the company, and off you go. They don't look at management or the disclosures about the accounting issues. That doesn't compute with them, so they don't do it. This guy, he's not really, I don't know if he's a true valuation guy, but this one always killed me. I actually commented, which I don't even know if my comment exists. He might have deleted it. So he does a video on Stanley Black & Decker. And so he talks about the business, and the reason he's covering this is because it's cheap, right? So now we're delving into the cheap. So is it a good investment? He's just saying it's a cheap stock. It's like at the time he did this video, I think Stanley Black & Decker was like a PE ratio of like 8 or 9 multiple. So he's just like, oh, it's cheap. There you go. So now we're in the realm of the YouTubers. Cameron, you got the ones that do discounted GWiz math spreadsheets. And then now you got people like this. a stock goes down, so surely it's going to go back up again. And then they put a valuation on it so they can fill content. So now we're into the cheap value people, right? But what he doesn't cover, and he talks about the brands. I don't even want to play this. I can't stand this video. And then he goes through valuation. Oh, look, we got a valuation, yay, spreadsheet. He doesn't cover they had accounting issues also. Stanley Black & Decker had accounting issues, right? Very bad accounting issues. You can go Google this stuff. It's not hard to find with their auditors. They had to restate financials. It was not good, not a good look. Also, when I looked at this company, if you went on job review websites like Indeed or Glassdoor, I think it was, they were not well reviewed. Like, I know you get more negative than positive, but when I looked at Black & Decker, man, people really hated working there. Like, very constant, consistent message of management sucks. And I saw it across like 2 or 3 different review sites that I can go look at. Again, it's not computable. You can't compute this. It's just something that you could do as due diligence. So like we could look at, so like, it's not a turnaround play. There's no turnaround. Just because a stock is cheap doesn't mean it's a turnaround. It's just a cheap stock because there's nothing interesting about this company. That's why it's cheap. And they can't compute that. And then you can go look, like, okay, like where's the investment here? Could there be a turnaround? But is it a turnaround, or is it just something happens to the company that they all of a sudden become a growth company like General Electric? General Electric was crap, and they broke the company up, and now it's an interesting investment, pieces of it. Stanley could do the same thing, right? So a cheap stock could become a turnaround that would make it a growth company and investable, maybe, but this is not a guarantee. So if you're buying this, you're buying it because it's cheap. That's really all you're buying this for. I see nothing. And the other concern I've always had, you can't see how their competitor is doing, which I've always said. Harbor Freight's their competitor, I would argue. And you can't look at Harbor Freight's financials because it's a private company. So you can't even see how maybe Harbor Freight is blowing the doors off earnings, 15% growth every year, stuff like that, opening stores like crazy. You're not going to see it. So none of that risks. He doesn't identify any of these risks. So it's just a cheap stock. So of course, you can buy it and you can perform like crap when the markets have done amazingly in 2023 and this year. You buy this because of his video, and then there you go. You deserve that return. All right, we're going to have, I think I have one more or 2 more. Okay. We cannot not talk. You cannot talk about value without this clown. Again, this is the worst investor on YouTube. The worst investor on YouTube. You can't even compare anybody to this man. Me, Kev, it doesn't matter. This is the worst investor on YouTube. Historically underperforms in every situation. I've done all the videos on this. He told you to buy some weird Indian scam company over Tesla that went bankrupt. That he called an American company, even though you could look at their financials and see that it was actually like a front for like an Indian telemarketing scam. It was in their financials, but he called it an American company because that's what they filed their headquarters as. So this man, complete garbage of an investor. He buys 3M. He was so proud of himself for buying 3M, which is a value trap of value traps. Could it turn around with the spinoff? Yeah, it could be a turnaround play. Is it now? I don't think so. But we'll see. I'm watching it. So he buys it a while ago. He makes no talk about the lawsuits, and I bet you people talked about it right here. Look at this. Lawsuits. Every comment is like, how could you buy 3M and you don't even talk about the lawsuit situation? It wasn't even in his video. Here you go. Hey, Paul, what about the legal battles 3M is facing? Impact cash flows. Non-computable, right? It's not something in their financials. It's not a discounted cash flow. He's buying it because it's cheap. So he's a cheap investor. I don't even know what you want to call these people. It's just buying it because it's cheap. So trash investment. He's buying something he doesn't even fully understand what he's buying. Because what did he do? Let's go here. Throw numbers in this useless chart. Strongman could make this thing in like 25 minutes, literally, and then 20 more minutes to put draw pictures on it. This is like middle school level math. I could build this too. I built one. Took me a little longer. So here he throws all these projections that mean nothing, that are not based on anything. The Dean evaluation would tell you garbage in, garbage out. with these valuation tools. And the simpler you make them, the better. Because he came on their channel, and the dean, Ashwath, I think. Sorry if I mispronounced it. He's like, why do you have 3 scenarios? It's one company and one stock price. You should have one scenario. So he made fun of them for having 3. So here he does his little value, and he's like, oh my God, look, the stock is cheaper than my mid. It's a buy. It's a buy. I don't understand anything about the lawsuits over the earplugs. He doesn't understand anything about the Forever Chemical lawsuits, which could spur up again in multiple countries around the world. He doesn't know any of this. He bought it because of this. So there you go. Right now, it's sputtering around. It's just like Stanley Black & Decker. It's not crashing like Tanner stocks to go 90% down, but it's done nothing, right? So what's worse? Yeah, okay, a stock doesn't have to lose 90% to be a failure. You just opportunity cost missed out on the gains of SPY and QQQ. Buying shit like this. You missed out. Great runs. And he bought this 10 months ago. Think of the run of the market from last fall to today. He missed all of that with whatever money he put into 3M. So more failing. Just failing all over the place. The last thing, this is kind of the last one, but this is like the biggest. Now we're like Alibaba is like, so now just the stock of value investors. So now like super investors, YouTube, crap value investors, and now like what is actually like identified value opportunities. They've pinned Alibaba, I swear to God, is a value stock that will make you money. You can look at all these, look at them all. And mind you, he bought Alibaba dollar and lost money, and then he tax loss harvested, and then he bought it back and claimed that he was only down 7%. So he's a liar. But there's other people, of course. You know, Jeremy's got, I don't know if he bought it. Here's all the value Alibaba people. Oh, look, Alibaba. You know, they'll say like, oh, Munger bought it, and then they completely miss the fact that he admitted it was a mistake and regretted buying it. They missed that part. But all this coverage of Alibaba. Because if you look at it, again, if we're looking at the balance sheet, the future cash flows, what they pin themselves on, it looks appealing as hell. And they've said that when it was 200, 150. It just keeps dropping, and they keep telling you it's a value play as the stock just keeps being a complete disaster. Because I would argue if your thesis is China, I think a lot of their theses are actually China. I don't think their thesis is Alibaba specifically. You could play China a better way than Alibaba and get rid of single company risk, which I actually have a small play on China. It's degenerate because China is degenerate. But I'm not betting on any one specific company. So this is like, again, it's like they're failing. Now, this is an investment that's not just flat like the other two I showed you. This is an investment that they've lost a lot of money on, and they don't look at political risk. And I've personally asked Paul in his Everything Money live streams about Alibaba, because he bought it repeatedly, about the risk of China. He says he just increases his discount, his margin of safety. That's not the right answer. It's not the right answer. And China is uninvestable long term. I think you could trade it, but I think it's uninvestable. So, but he doesn't, it's non-computable risk, and they don't deal in those spheres. These value people on YouTube, if they can't put it on a spreadsheet, they don't think about it. But they will tell you that they considered it. If you ask them, anything you ask them risk-wise, they will say they considered it, but they have no proof that they did actually. It didn't alter their thinking at all. So the never-ending train of value investors, because value investing associates you with a common term that everyone's aware of online. So views. Warren Buffett is attached to it. Again, notoriety, more views for these YouTubers, but none of them are historically what I looked at is value investors. Like, not like what Roaring Kitty is, a value investor to the blood or to the core, and he killed it in the market, right? And then he left. So there you go. That's my take on all these people. So stop screen. So there is, wow, hour. There's a lot to this topic. So there was another example of a value investment, old school value investment, but I didn't ask the person if I could talk about it, so I'm not gonna bother. It's okay. But I would agree with Howard Marks. I think from what my understanding of what value investing actually is, as far as Benjamin Graham detailed, you could use that. I know of a specific investment that someone I know did that I would argue is a value investment. They defined a company that had real estate that they had purchased a long time ago, and then the company was going to get bought. And then when it get bought, then the hope would be that the market would reset those valuations to present value of this real estate, and they would realize these gains in the value of the land. That is a value of investment to me. You're understanding that there was the intrinsic value of the stock was higher than what it actually was on the market, because you knew that the fair market value of their books was higher than what they are actually representing. That is, to me, that is a cigar. Or it's not even a cigar. Don't even worry about the cigar butt idea. That's a value investment right there. So this is like, I don't think you could fill a whole portfolio with investments like this. I don't think these opportunities are always present that you could find, but they can be out there. And if you identify and understand what you're doing with it, I think it's a great tool for you. But if you're mostly indexes, and then you don't have the pressure of performance being an all individual stock portfolio, I think you could find one of these a year of a real value investment opportunity in a company. So again, it's just a different way of looking at this as a style. So I agree mostly with Howard Marks and Roaring Kitty on value investing, is what I think. But oh my God, Gil, you are going bananas. Trump got $1 million loan from his dad. Where did Trump come in? I've not been following comments. So, okay, before I leave, I got to check this. What did he say? Let me pull up a page. Cybertruck's delayed? Trucks delayed. Oh my God. What happened? Tesla is canceling Cybertruck performance. Unexpected delays reported by a multiple crash. Tesla stopped all Cybertruck deliveries for 7 days due to an issue with the accelerator pedal. Oh my God. Oh. And you people think there's going to be some mind-blowing robo-taxi announcement in August? Like, you don't find it weird that the stock is tanking after deliveries look like crap, and now he's going to do an exciting robo-taxi announcement after the terrible delivery numbers Q1? Friggin' people fall for this shit. It's unbelievable. I'm embarrassed for you people. I don't know. Oh, that's funny. Yeah. Who knows why, right? You don't know. Anyways. Thank you for listening. Me ramble about value investors. So, you do your thing out there. I'm sure someone's going to tell me I'm totally wrong, and they outperform the market doing value investing. And okay, what I think they're probably doing is doing more quality investing with a discounted cash flow model, is what I would say they're probably doing. Because that's kind of what I see people doing. They have, and you are looking at non-computable factors before you value it. So we're not saying that you can't use a model to value a stock. That's not the argument. Valuing a stock, one side. Value investing is a different topic, which is what we were more talking about. But if you have some sort of forward projection analysis of a company, I'm probably on board with you. If you're not looking at those non-computable future projections of the company, I don't know what you're doing. You've got great ETF products that Benjamin Graham probably would have loved, and you could see he was thinking about it. So thank you for listening. I probably went to a live stream tonight. I don't know. We'll see. So have a good night, and we will hopefully get better spring weather coming. All right. Bye.